Hey everybody, this is Jason and I am recording this on August 5. It's about 3:15 p.m. and the markets are set to close here in 45 minutes for the week. It looks like this will be the worst week we've had in the market, I think, in about 3 years. And the month of August is already setting up to be a very poor sort of end to the summer or midsummer month. Revisiting a chart here again, so I think 3 days in a row, and this is going to be my limit, and I'll not bore everybody with charts, but I had an interesting email come to me. A client was asking me about something that's called the Golden Cross, and if we would be using that to help protect clients' assets from a further market decline. So first thing I want to do is explain to everybody what the Golden Cross is. It's a term, I'm not even sure who created it, but what it's referring to is when the 50-day moving average of the market drops below the 200-day moving average of the market. So for the purpose of this video, what you see here, the blue line, I've shown this before, but the blue line is that 50-day average price of the S&P 500, and the red line is the 200-day. The reason they brought this up is because you can see right here, the blue line is looking like it's really close to crossing through the red line. Now, as the story goes, when the blue line here, the 50-day average, drops below the 200-day average, that's kind of an accepted way of measuring if we're in a bull or bear market. So you can see this is a 3-year chart here showing the last 3 years, and you can see that the market obviously was in a decline pretty severely in '08. This spot right here is where 2009 began. And you can see that the official sort of bull market started around June or July of 2009. And from that point, the market has risen about 40%. You can see it barely, it's kind of covered here, but the market actually would have fallen through that. So it would have went into this first sort of bear market territory back in early 2009. So when people think about this recently, what they're seeing is, hey, you know, last time this happened when it, and people forget this time here, which I'll explain in a second, but last time this happened, market dropped, you know, a huge amount, and had someone moved out of harm's way, it would have saved them a lot of heartache and pain and suffering in their portfolio. So this is that little spot where it kind of proved to be wrong. Every once in a while, this method, it will actually like in this case, you can see this is around July. This is last summer, and I've covered this before where the market dropped about 20%, and then it kind of turned on a dime and then ended up going up 35%. So this particular juncture, you can see that the signal, if you will, would have said sell everything in July of 2010, and then it would have told you, oh, it's okay to buy back in around November. And of course, from that time period, the S&P was about 1,000. And then when it finally signaled things were safe, it was up around almost 1,200. So, you know, the danger of following something like this with an entire portfolio, in other words, using it like a light switch. This happens, I sell everything. Things go good, I buy again. Is that sometimes you'll end up selling out and missing out on, in some cases, some pretty large gains. Like in this case, again, that's, my math's any good, see, it'd be about a 20% gain. In any event. But those who are big fans of this style will say that, you know, the times that you miss these shorter term gains are far offset by the times you avoid these huge major losses, which over enough time, I think if you measure this like 50 or 60 years or longer, it does prove to be true. So I thought I'd share with everybody some actual statistics on this. So I'm going to pull up a little Excel spreadsheet that I created, and I'll try to fit it inside our recording zone here the best I can. So let's kind of look at it like this. So what this shows here, this is the last 30 years, so going back to 1981. And what we're seeing here, I went ahead and I took the S&P 500. This is looking at this measurement, and to make it a little bit easier, I just use the monthly data. In other words, if somebody watches this stuff every single day, I think they could go batty. So another way that people will look at this idea of using the Golden Cross is to look at it in terms of just once a month, perhaps at the end of every month, use that as a trigger. So worst case scenario, you know, 12 times a year someone has to check something that takes 5 minutes. And so the red line is the market. the last 30 years. It's showing buy and hold basically. And it's just, again, presuming someone starts with $100,000 to keep the numbers round. And they ride out all the big ups and big downs and big ups and big downs. And then you can see kind of where they finish right now. I think it'd be somewhere in the neighborhood of $900,000. Now, on the flip side, this blue line, what this is showing is that someone adheres to the model we just talked about. So they're using the golden cross, but they're using it just on a monthly basis. And so what you can see is that, again, sometimes it triggers and it causes like this little bit you see right here, and you see a little bit right here. It triggers the portfolio to say, hey, I need to move out to cash. And when it does that, sometimes it doesn't get all of the upside of the market. And you can see that it does look a lot smoother, though. The blue line in this case is, finishes below where the red line does, but it does so without having the huge gyrations of the last 10 years. So in a really long-term bull market, like the one we saw from the early 80s that really ran all the way until about 2000, this methodology would have been very hard for most investors to stick to because they would be sitting there with basically less than half the gains of the broad market because they were adhering to this risk management policy. However, they would have looked really smart in the last 10 years because you can see here, of course, in 2000 or thereabouts, the market hit a peak that to this day it still hasn't recovered. I mean, the S&P is still down 25% or thereabouts from its high, all-time high. And frankly, just in the last few years, from the high it hit in 2007, it's also still down about 30%. So the market still needs to go up about 40% to get back to where it was at its high. So if you're an investor in stocks and you're looking at your portfolio and going, well, gee, I'm not back to my high. Most people aren't, if they were investing in stocks. Now, if you had a balanced portfolio, perhaps things would be different. But for this discussion, again, I'm just talking about stocks. Now, just to make this make a little bit more sense to everybody, in other words, to answer the question, should you or should you not take some type of action when the market goes into these time periods of where the golden cross, if you will, the sell signal when the 50-day average drops below the 200, I have some metrics anyway on the actual portfolios. So again, it's just looking at a model, but here's the actual numbers. So those who are curious, how does this really look and work? What we can see is that at the end of the day, the average return of the buy and hold investor would be about 7.6% the last 30 years. That's this right here. If someone was adhering to this idea of selling when it looks like there's a potential for a major decline, their returns are slightly lower, about 0.4% lower per year. An interesting thing I did, though, is I looked at the standard deviation, which is the variance, essentially, of returns. And a commonly accepted way of doing that is looking at just the past 3 years. The numbers don't change actually a lot if you go the last 30 years. But in most simple form, this is one way of measuring risk. And if we look at the risk, if you will, by having a risk management protocol like this in place, it cuts the risk about in half. So you can see that buy and hold measures at 6.17 versus the model here that we're tracking is at 3.06. In a very simplistic way, I just divided essentially the risk by the return. You can see that per unit of risk that you're taking, the model is getting about 2.37 units of return, whereas buy and hold is at 1.23. So in its most simple form, the risk-adjusted return, in a simple way anyway, using this style of management is almost twice as good, meaning you didn't take nearly as much risk, but you got almost the same amount of return. Now, before people assume that this is a surefire way to always get great returns in your stock portfolio, I went ahead and checked, and the largest monthly loss is the same. In other words, they both still experienced one of the really, really big declines. I think that would have been, on this chart anyway, this one right here, this big dip you see in, looks like 98 or thereabouts. So having a model like this in place does not insulate somebody from having bad months. Certainly, it might help avoid really bad years, but it doesn't mean in the short run that you won't sometimes get caught when a market initially starts to sell off. But in the long run, you can see here, this column right here, the last one, or row I should say, shows that, if you have a model like this, you have substantially less bad months. So in 30 years, there's 360 months. And we can see that in this case, this model, this style of risk management anyway, would have cut your losing months your portfolio would have lost, by about a third almost. So instead of having 141 losing months out of your 366, you have 96 losing months. Either way, interestingly, when you look at these numbers, you can see that having a risk management protocol does help, but there is still certainly some downside to it. Now, to answer the question that was posed to me, do we actually pay close attention to things like this golden cross? The short answer is yes, we do. A couple of the models that we run that are stock specific will reduce their position size if this blue line here crosses the red one at the time of our next rebalance, which will be at the end of August. So we'll have to see the next few weeks kind of what plays out. As I mentioned in past videos, the market is getting pretty severely oversold. When we look at it on a daily basis, we also oftentimes look at the market on a weekly and monthly basis, but in the very short run, I don't know if it's going to happen today yet, or if it happens Monday or Tuesday, but markets don't typically, even in really bad markets, just go down perpetually without having at least a few big up days. Sort of they call it a dead cat bounce is another industry term. So enough for my video for today. I want to let everybody know that we are watching, obviously, what's happening in the markets very closely. I think what's going on right now is what a lot of people are calling panic selling. I tend to agree with that, which just means that people are panicking, and when they panic, they sell. And the value of the market is a direct reflection on whether or not people buy or sell. So if there's a lot more people selling, prices go down, and that's irrespective of what's really happening in the market or in the economy or the health of companies from a fundamental standpoint. In other words, if they're profitable or not. So we do have to obviously keep an eye on the long term. In the short run, I do think that there's a very high potential that we will have this cross that we're showing right here. And if that does happen, what I think investors will find is that our portfolios, which they're already pretty balanced and conservative, may get just a tad more defensive. But we don't want to get caught in the same trap that happened last summer, which is you get defensive and then you miss a good rally. So we would never actually go 100% to cash just by one indicator like this, though this is one that, as you could see from the chart I showed here, does help avoid some of these really major catastrophic losses. So that's it for today. I hope everybody has a wonderful weekend. Certainly, I understand if people are a little bit concerned about their portfolios. It is not something, though, that is unusual for a market to correct. In fact, it's very natural and is actually healthy in the long run. But if things do get out of control, I will continue to post videos and articles and make sure that our clients and readers know kind of how we're handling what's going on in the financial world. So again, have a great weekend. Thanks for checking out this video.